Hello and welcome to another chapter on US taxation. Today we are here to present on another head of income, which is capital gains. So in the previous chapter we discussed rental income, which arises when property owners earn income by leasing their real estate to tenants. We learned how landlords determine the total rental income, deduct the allowable expenses, apply depreciation, and then calculate the net rental income. And we explained that how the information is being finally reported via Schedule E and then finally reported into Form 1010. Now, in today's discussion, we are going to cover the capital gain. We are going to understand all about capital gain. We're going to understand about the concept of the capital asset, the holding period for which capital asset needs to be held, and then the capital gain which arises on the sale of those capital assets, then classification of that capital as capital gain into the long term and short term. We'll also understand the limitation of the carry forward of the unabsorbed capital losses. We'll also understand the flow of the information, that how it flows from forms to the final form 1040. So with this, let's move to the first slide and look at the detailed agenda that we're going to follow. Okay, so the key agenda that we're going to cover as a part of this chapter is we'll understand the concept of the capital gain in context to the US. We'll understand the definition of the capital asset, and then we'll definitely have a look at how understanding on the capital gain and the capital losses. Uh, Post which we'll try to bifurcate the gains or the losses into the short term and the long term, and then the concept of adjusted basis for the assets. So normally there are two bases, cost base and the adjusted basis. We are going to look at that. Then we'll have a understanding on the capital loss limitation. We'll quickly spend some time in understanding the concept of Schedule D and the Form 8949. We'll have a detailed example to explain how the information is being calculated and then how it is reported, and finally being reported in Form 01040. And then a quick snapshot of what we have discussed and learned today, and then transitioning to the next chapter, which is the adjustment and the deductions. So we'll start the discussion with the first slide. Okay, so capital gain arises when a taxpayer sells a capital asset for more than its original purchase price. The simple arithmetical formula. The difference between the selling price and the cost price for acquiring the asset represents the capital gain, which is generally subject to the taxation under the US tax system. The important thing that we have to understand here is that there is no concept of indexation in US, unlikely India. Unlike India, wherein the long-term capital gain are subject to the indexation, there is no indexation in the US. There is a concept of adjusted basis that we are going to talk about in the upcoming slides. Capital gains are commonly generated from the sale of the investment assets, and the tax treatment may vary depending on the type of the assets and the holding period. Capital gain and losses are typically reported using Schedule D, and detailed transactions are listed in the Form 8949. The final gain or loss is reported on Form 1040. So we'll understand what is capital gain. So simple formula is there: selling price minus cost price is the capital gain. So example, an investor purchases stock for $5,000, later sells for 8,000. So capital gain is 3,000, and this 3,000 represents the taxable capital gain income. Whether this 3,000 will be taxable at the normal income rate or the special rate will depend upon the fact whether the asset was held for less than a year or more than a year. So what is the capital loss? Capital loss occurs when the capital asset sold is less than its purchase price. For example, shares which were purchased were 10,000 but sold at 7,000. This is a capital loss of 3,000. Capital losses can often be used to offset the capital gain, which reduce the overall tax liability. Some examples of capital assets are the stock and bonds, mutual fund, real estate investment, cryptocurrency, investment property. These assets are generally held for investment purposes rather than for the regular business operations. This clearly explains the concept of the capital gain, capital loss, and the capital asset. So with this, we'll move to the next slide. Okay, so when do the capital gain occur? So capital gain are recognized only when the asset is sold or exchanged. The event is known as the realization event. So basically, the event is either the asset is exchanged for a consideration, or if it is not for consideration for a fair value, or if the asset is sold. For example, selling share in the stock, selling real property, exchanging investment assets, and selling the valuable collections, collectibles. So until the asset is sold, the increase in the value is considered as the unrealized gain, which is not taxed. So this is simple example, which are there in the normal tax concept in India as well. Then we come to the important concept of holding period. So if the asset is being held for 1 year or less, then it is a short-term capital gain. If it is more than 1 year, it is the long-term capital gain. For example, Michael purchased the shares for the company for 4,000 and after 2 years it is being sold for 6,500. So 2,500 is subject to the long-term capital gain tax and it will be taxed at the special. So we'll move to the next slide. Okay, now having understood the concept of the capital gain and the understanding what is capital asset, what is the concept of long-term and short-term capital gain, and then concept of the holding period, let's spend some time in understanding the concept of the capital asset. So capital asset is any define any property owned the taxpayer personal use or the investment purpose. Capital assets are important in taxation because sale or exchange of the business of these assets may result in the capital gain or the capital loss. So whenever when a capital asset is sold, the gain or loss from the transaction is reported in form 8949, which is being summarized in schedule D, and then final information is reported in form 1040. Now, when we define the capital assets, under US tax law, capital assets generally include all the property owned by the taxpayer, uh, except for the certain specific exclusion. These assets may be held for the personal use, investment purposes, long-term appreciation in value. When such assets are sold, any resulting gain or loss is treated as the capital gain or the capital loss. Common example of the capital assets are stock and bonds held for investment, mutual funds, investment, real estate, personal property, collectibles, cryptocurrency investment. These assets are typically held by the taxpayer with the expectation that their value will increase over the passage of the time. Assets which are not treated as the capital asset is the inventory, which is held for the business sale, property used in the trade of the business, account receivable generated from the business operation, supplies used in the business activity. So assets which are being held for the personal use for capital appreciation purpose are largely treated as the capital assets, and any sale of these assets will subject to the capital gain tax. But the assets or the realizables which are specific to the business operation, those are not being treated as capital gain because these are normal business operation of the business and will be treated as a normal profit and loss or for that particular business. So we'll move to the next slide on the capital asset. So the second slide on the capital asset, we'll quickly understand the concept of capital asset in taxation and why it is important because any capital asset, if it is being held for less than 1 year, is subject to the short-term capital gain tax of the normal rate. But if it is long-term, it is subject to the long-term capital gain and special rates are there. So key factor affecting capital assets are holding period, adjusted basis, and the selling price. And we are going to talk about the adjusted basis in the upcoming slides. Okay, now we'll understand the capital gain and losses, how it's being done. So capital gain arises when the taxpayer sells the capital asset for more than the price at which it's required. And the capital gain is calculated by simple formula, which is the selling price minus cost basis, which is the capital gain. A quick example here, investor purchased stock for 5,000, later sells at 8,000, capital gain of 3,000 is there, and then 3,000 represents the taxable capital gain income. While capital loss occurs when the capital asset is sold for less than the purchase price, typical example, shares were investor buys some shares at 10,000 but sold at 7,000, that's the capital loss of 3,000. And capital gain are recognized only when asset is sold at exchange, selling of the share stock, selling real estate property. So all these are the realizable value at which asset is being sold and the triggering point at which asset is being sold and then taxed as a capital gain. So capital gains are taxed basis the holding period, which is dependent upon the holding period, which is less than 1 year or and more than 1 year. So we'll move to the next slide. Okay, so we'll quickly have a quick overview of short-term and long-term capital gain, though we typically understand that it depends upon the holding period. So what is short-term capital gain? A short-term capital gain occurs when a capital asset is sold after being held for 1 year or less. So asset holding period is 12 months or less, then it is taxed as a normal income tax rate, and rate may depend upon the bracket in which that individual falls. For example, purchase price of stock was 5,000, selling price 7,000, gain of 2,000. If the stock was held for 8 months, the gain is treated as short-term capital gain and the tax is taxed as the ordinary income tax rate. A long-term capital gain is the long-term capital gain occurs when the capital asset is sold after being held for more than a year. So asset holding period is greater than 1 year, taxed at a preferential capital gain tax rate. designed to encourage the long-term investment. So brackets are here. Lower income tax, there is 0% tax on the capital gains. Moderate income tax pay 15%, and then high income tax is 20%. When we talk about the holding period, well, we quickly compare the concept of long term versus short term. We have created a kind of a table here to differentiate between the short term and long term. So holding period for short term is 1 year or less. For long term, it is more than 1 year. Tax rate is ordinary income tax rate for the short term capital gain, but it is preferential capital gain rate for the long term capital gain. Typical tax rate is 10 37%, and it is 0 to 20% in case of long term capital gain. For investment perspective, short-term capital gain is the short-term trading, while long-term capital gain is for the capital appreciation and the long-term investment strategy. So we'll move to the next slide then. Okay, now we're going to talk about the very crucial step for the capital gain, which is the adjusted basis of the asset. So the adjusted basis of asset is represents the original cost of the asset after accounting for the certain adjustment of the time. This is very important because in the US there is no concept of the indexation, and hence the only benefit that is available is the adjustments that can be done. So adjustment basis is important because it determines the true gain or the loss when the asset is sold. Transactions involving capital assets are reported in Form 8949 through Form Schedule D. So we'll quickly understand the concept of the adjusted basis here. The cost basis is the starting value of the asset for the tax purpose, which generally includes the purchase price of the asset, the sale tax placed on the purchases, transaction fee or the commission, and the legal or the closing costs associated with the acquisition of the asset. For example, if the stock is being purchased for $10,000, the brokerage commission was paid 200, the total cost basis is 10,200. Now question comes, what is adjusted basis? So over the time, the cost basis may change due to various adjustments. The adjustment may include the original cost. The adjustment is calculated as the original cost basis, and then what we have to do, we have to addition or the improvement minus we have to do the depreciation or the other reduction, and then we'll get the adjusted basis here. So this adjusted basis value is used to determine the taxable capital gain or loss when the asset is sold. So which means that we have to do the adjustment to the original cost to calculate the adjusted basis, additions for any improvement, and deductions for any depreciation or the other reductions. So adjustment that increase the cost is a certain expenditure increase the basis of an asset because they add value to the extended or useful life. For example, capital improvement made during the real estate, major renovation or structural upgrade, legal fee related to defending ownership for the property, and special assessment for the infrastructure improvement. So which means that this is equivalent to the cost of the improvement when we talk about in context to the Indian scenario. So this adjustment actually increased the cost of the original asset. So original property was 2 lakh, home improvement cost was $20,000, adjusted basis becomes 2 lakh 20,000. So move to the next slide and look at the adjustment that decreases the original cost. Okay, so we have seen the adjustment that increased the cost. Now we are going to talk about the adjustment that decreased the cost. So certain factor reduces the basis of an asset over the time. For example, depreciation deduction claimed on the rental property. This is normal treatment when the property is being rented and depreciation is being claimed. Insurance reimbursement for the damages, casualty loss reduction, and the certain tax credit received. These adjustments lower the asset basis and increase the taxable capital gain when the asset is sold. So which means that the cost is reduced because of these adjustments. So example, calculating the adjusted basis. So Sarah purchased the rental property for $3 lakh. Original purchase price was 3 lakh. Capital improvements 40,000. Depreciation claim 30,000. So adjusted basis calculation is 3 lakh 10,000. If Sarah later sells the property at 350k, the capital gain is 350 minus 310, which is 40,000 capital. What is the importance of an adjustment basis? That understanding adjusted basis is important because it helps the taxpayer to accurately calculate the capital gain or the losses, reflect it to investment in the asset, and account for the improvement in depreciation and the avoid incorrect tax report. This is this very crucial definition of adjusted tax basis. So we'll move to the next slide then. Okay, so we're going to talk about another important concept, which is capital loss limitation. So we know that if the selling price is less than the cost price, then there is a capital loss. So capital losses occur when the taxpayer sells a capital asset for less than its adjusted price basis. In which case, capital losses like adjusted basis minus selling cost is capital loss. So which means that price of purchase is more than the sale, which means there is a capital loss. The concept here is that when there is a capital loss, what are the limitations? Whether those losses that has been incurred can be set off against certain set of the income. If yes, to what extent? and if not, then what is the treatment? So we are going to talk about that in this slide. So the first use of capital loss is to offset the capital gain. So capital gain for a stock trade is 6,000, capital losses on other stock trade is 4,000. So this will be set off among themselves. So net capital gain is 2,000. So only the net gain is taxable. So which means that any capital loss which has been incurred during the year can be set off against the capital gain in that particular year. Net capital loss limitation is that if the total capital losses exceeds the total capital gain. So which means that after adjustment, if losses exceeds the capital gain, then what will happen? The losses are there, and then those losses will be adjusted with the other income. And what is limitation to that? The taxpayer has the net capital loss. However, the tax limits the amount that can be adjusted against the ordinary income. So maximum deduction is single or married filing jointly. The deduction is 3,000, and married filing separately is 1,500. This is the maximum amount that will be adjusted in that particular year, and whatever balance is there, it will be carried forward to the future years. So this is the concept of capital loss limitation. So we'll move to the next slide. Okay. So having considered that the capital losses that can be set off against the capital gain in the same financial year, and then if capital losses is more than the capital gain, the losses will then be adjusted against the ordinary income with the limitation. And if those are not being fully adjusted, then this will be carried forward. For example, total capital losses are 10,000, capital gain is 2,000, net capital loss is 8,000. Reduction allowed in the current year is 3,000, so remaining losses of 5,000, it will be carried forward to the future tax year. Ordering rule is that capital gain losses must be applied to the specific order. So short-term capital losses offset short-term capital gain, long-term capital losses offer long-term capital gain. Remaining losses can be set off the other category. Any remaining loss may offset through the ordinary income up to 3,000. And then importance of capital gain loss rule is that capital gain limitation helps to prevent the excessive reduction against the ordinary income, ensure fair tax treatment, and then encourage the proper reporting of the investment transaction. This is very, very important that all these capital losses are adjusted. So we'll move to the next slide. Okay, so now we will talk about a very important concept of Schedule D and Form 8949, which is being used to report the capital gain or losses. So when the taxpayer sell the capital assets such as stock, bonds, or the real estate investment, the resulting capital gain or losses must be reported to the IRS. So two important forms for use in the purposes: Form 8949 and Schedule D. So these forms work together to report the individual asset transaction, calculate the capital gain, and determine the net taxable gains, which is included in Form 1040. So what is the purpose of 8949? Form 8949 is used to report the detailed information for each capital asset transaction. So taxpayer lists every sale or exchange of the capital asset, including the description of the asset, date acquired, date sold, selling price, what is the basis of the cost, adjustment basis, calculation of the capital loss and or gain. And this form helps to ensure accurate reporting in each transaction before total are summarized in the form Schedule D. So Form 8949 has two sections: Part 1, which speaks about the short-term capital assets, and Part 2, which speaks about the long-term capital assets. Now, Form 8949 is at the asset level, but the summarization of information for the long-term and capital gain or the short-term capital gain losses is being done via Schedule D. So Schedule D summarizes the total form of 8949, and it consolidates to determine the total short-term gains or losses, total long-term gains or losses, net capital gain, and then the final results, which is being finally reported in Form 1040. And it includes the information like the total carry forward of the losses post adjustment against the ordinary income, because in US there is no time limit for which losses can be carried forward. It's an indefinite period, and also the application of the limit of 3,000 to adjust the amount against the ordinary income applies each year, and same is also applicable for the carry forward of the losses as well. So we move to the next slide and look at Schedule D, understand the various parts to it. Now, if we look at Schedule D, so Schedule D has three parts: summary of the short-term capital gain, summary of the long-term capital gain, and the calculation of the overall net capital gain. So example, Schedule D calculations: so short-term capital gain of 3,000, short-term capital loss of 1,000, long-term capital gain of 5,000, and long-term capital loss of 2,000. So these are the very steps that how we do the calculation of various information, and then 5,000 is the total capital gain which is reported in the form 1040. So information flows starts from the form 8949. It moves to the schedule D, and then finally net income or loss is being reported via form 1040, which is the final return form in which information is to be captured. So with this, move to the next slide and look at the detailed example. Okay, so now what we have done, we have created an example here which demonstrate whatever we have discussed till now. So Emma is an individual investor who sold several investments assets during the tax year. So she must determine whether she has the capital gain or the loss, and whatever information she has, it has been captured in form number 8949 and finally summarized in Schedule D, which will be reported in form 1040. So Emma completed the following transactions for the year. So stock A, stock B, stock C, and mutual fund. We have the purchase price and selling price, and then we have the holding period for each of them. So step 2 is to calculate the gain or loss for each transaction. So which we have done the calculation selling price minus cost basis. So we have determined the gain for stock A, gain the loss for stock B, stock C is gain, and then mutual fund D is a loss A. So in step 3, what we have to do, we have to separate the long term and the short term transactions. So short term is 1 year and less. So stock A and stock B fall in that category, and stock C and stock mutual fund D are the long term because the holding period is more than 1 year. So we'll move to the next slide and look at the rest of the example. Okay, so next step is calculate the net short-term capital gain or loss. So short-term capital gain 2000 minus short-term capital loss from 1500, 500 net short-term capital gain. Step 5 is calculate the net long-term capital gain or loss. So 3000 long-term capital gain minus 1500 long-term capital loss. So we have 1500 net gain. So net short-term 500, net long-term 1500. So total is 2000. However, 1500 will subject to the preferential rate of the tax, and short-term capital gain will be subject to the normal tax. This is the bracket for that particular individual. So this will be captured in form 8949, summarized in Schedule D, finally reported as the net capital gain of 2000, but the tax treatment would be different and it would be reported in form 1040. So with this, we actually understood the complete concept of the capital gain with respect to the US. Let's just quickly move to the next slide and understand the synopsis or summarize what we have discussed till now. Okay, so what we have learned in this section, in this chapter. So we learned the concept of the capital gain which arises on the sale of the capital asset. We understood that when they arise, what is the concept of the capital asset, and when the sale is considered as the capital gain or capital loss. We understood the concept of the offsetting the amount to reduce the overall tax liability by some improvement which is being done to the assets. Those is added to the part of the cost, whereby if cost is increased, the overall gain on the sale of the asset will reduce. And we also understood some of the adjustments to the to the cost basis, which reduce the cost, which is like depreciation. The holding period is the most important factor in determining the long-term or short-term capital gain. We understood the concept of adjusted basis regarding capital improvements. We also understood that the capital loss can be adjusted against the capital gain for that particular year, and if it all could not be adjusted, then whatever unabsorbed, unadjusted capital losses for that particular year can be adjusted against the income, ordinary income of that individual in that year to the subject to certain limits. And if the still losses are there, that will be carry forward. The carry forward with respect to the US is indefinite. There is no limit to it, and for each year the applicable limit of adjusting it through ordinary income will apply if the capital gains are not there. And then a capital gain must be reported in form 8949, which is being summarized in Schedule D, and the final information is being reported in form 1040. So with this, we'll come to the end of this chapter. Let's quickly move to the final thank you slide and look, understand what is it that we're going to cover in the next chapter. Okay, so in this chapter, we understood the concepts of the capital gain assets, capital gain losses, concept of the holding period, and other relevant aspects that are required to understand the capital gain and the limitation of the losses and carry forward of the capital losses and adjustment in the future. So with this, we actually covered all the major heads of the income, which includes salary, interest, and the dividend income, self-employment income, rental income, and then today we have completed the capital gain. So in the next module, we are going to talk about the adjustments and deductions, which help to determine that how our adjusted gross income and is being derived, and then ultimately their taxable income is derived. So adjustments and deductions may include items such as the retirement contribution, student loan interest, health savings, share standard itemized deduction. And understanding these provisions is essential because they help us to understand how the taxpayer can legally reduce their taxable income and manage the overall tax liability more effectively. And in the next module, we will begin the exploring the concept of adjustment deduction and how that plays a crucial role in determining the final amount that income subject to the tax. And with that, let us move to the next module. We'll come up with the next module very soon. Until then, thank you, goodbye, and have a